All right, welcome to Find Your Next Six-Figure Infill Deal for Friday, July 10th, 2026. Today, we're actually doing something a little bit differently. We didn't have any new deals that looked really good this week, so we're actually just doing an education session and a Q&A, and then also covering some kind of the common objections or common concerns people have with infill deals, and then just kind of pulling back the curtains a little bit and showing some more into the background of some of these deals. So the first thing I wanted to do is, I guess, just introduce myself. My name is Zach Matson. I'm a builder and developer here in Boise, Idaho. I got started back in 2013 house hacking. I bought a couple of duplexes within a couple of years, lived in one side, rented out the other. Started flipping full time in 2016, and then got into infill development with my first deal in 2019, and then exclusively I've been doing infill development since 2021. And so yeah, that basically got me started, and I started scaling up over the few years after that. Started realizing really in 2024 that I couldn't possibly do all the deals I wanted to do. So in 2025, early last year, I decided I'd create a system that allows me to participate in more deals and bring my knowledge and expertise and my team's background into more deals, and help other investors buy deals, because I just saw so much opportunity on the market that really wasn't getting taken advantage of. And part of that is, lack of education. Most investors don't understand development. There's just not a whole lot of information out there. And part of it is, also there's just a higher bar to get into it. The financing's different. It's not as available as, like, buying a house flip or buying a rental house. So it's just a little bit different. So I basically created a system to kind of change all of those, or kind of address all those issues with being able to do these infill deals. Okay, so the first thing I wanted to cover is, I think a lot of people have concerns on, like, what can go wrong. And so that's, I guess, the first thing I wanted to talk about is what a bad deal looks like. And I actually have a couple of active deals that I've, analyzed or started to analyze, that are not good deals that I wouldn't recommend anybody buy, or at least, our clients buy. And so one of them was actually a deal that came up this week. I'm going to show on my screen here. Get to a share screen. Okay, so this is one of the deals that came on the market this week, this Hill Road, and this is actually a coming soon listing. And I didn't fully analyze this because really our background from a previous project that we did allowed me some additional insight to this project that I kind of realized that it wasn't going to work out. And so once I actually looked at the location on this, I realized the issues with it. So this is Long Hill Road. It's actually a great location in Boise. Um, Let me pull up the information on it here. And keep in mind, this is a coming soon, so it's not fully on the market yet, but I think you can still put in offers. I actually looked at this deal off market a couple years ago. I think before they got it approved. So this is actually officially approved, or was approved in early 2022 for 12 buildable lots. So I actually saw this project off market back then. And I thought the price was a little high there. I think they were actually even asking more than what they're asking now. But it's a pretty great spot. There's actually a development directly across the street from this. And so, like, kind of, when I looked at this, or like normally when I would look at this, I should say, there's a lot of great things about it that look good on the surface. So number one is, it has the correct zoning. It's on a large lot. It's 2.25 acres. The utilities are available in the main road. So you have sewer and water in Hill Road there. You have theoretically multiple exit strategies. And then you also have potentially good margins on the final builds. The resale prices in that area would look good. Again, it's a great location, and it has a prior approval for 12 lots. Now, because that approval expired, you'd have to get it reapproved, and that's not typically difficult. But the reason why I bring this up, and I guess the point of this is what could go wrong. So number one is somebody could buy this deal and before doing enough due diligence, or you don't have a thorough enough due diligence process, that you would buy this deal thinking it's a good deal, and it can be developed. And essentially what we found out on another property, like literally just a few hundred feet down the road, is so there is a water main in Hill Road, but it doesn't. So during our previous due diligence on another property that we were actually under contract on with a client, we found out that that water line doesn't have enough pressure to service anything uphill. So basically, you have a water main that can service anything south of Hill Road, but it can't service anything north of Hill Road. It can, you can have enough pressure to put in a fire hydrant on the corner, and you can get the fire department can service it, but you can't get any water pressure for the actual water lines for each house. And so when we had this other property under contract, we knew that like right off the bat, because part of our due diligence process is talking to Veolia or the other service providers. And so we knew that we didn't have the water pressure necessary. So, what we were going to look at is doing a community well. Um, and so what we found out kind of late in the process, luckily we had enough due diligence time, and we extended the due diligence so we could get this in, but we had a meeting with the city, and in that meeting with the city, it was basically at the very end of that meeting, that we found out that the city doesn't actually allow for community wells anymore on any new development in city limits. So essentially that nixes the whole community well on this lot. And then the public water, so obviously there's a lot water line there. Veolia would still theoretically service this, but we would have to pay for the infrastructure upgrades in order to service it. And what that means is you have to put in a big holding tank and a new pump. And it's not just, a holding tank and pump for this lot. It's literally so they can service the entire region. And when we started asking about the cost of that, essentially we found out that that's like a 7-figure cost. That just, it makes sense if you're doing a 40-acre development, but unfortunately, if you're doing a 2-acre development with 12 units, or even on this, if you maximize the density somehow and got up to 25 units, you're still looking at 50 grand per home just to get a water service in. And usually that's where your entire development costs are. It's usually between 50 and 80 grand on a new development like that. So when you're just talking water lines, that's normally a $5,000 cost, you're looking at 10 times the cost of that. That's typically not going to work out on a development like this, particularly with the purchase price where it is. Now, if you didn't have that big cost, then this site would actually be great. The numbers probably work out okay. I didn't fully analyze it because I knew this water line issue. But that $1 million for 12 acres, undeveloped, that's normally high, but in this location, I think you get it on the resale prices on those homes where you could justify that or pretty close to that. And then alternatively, if they want to sell this property, either, number one is either somebody's going to buy this and then unfortunately make a bad decision and find out what we know, and then probably turn around and lose money on it, or essentially then the other alternative is basically getting such a good discount on this property that it can cover the cost of that $1 million infrastructure for the water. Now I will say too, typically when we look at development deals where we can subdivide or it's land, this house it's like a trailer on a foundation, and I don't think it's great condition. And so the house itself is definitely not worth $1 million. They're relying on the land value, and unfortunately the land value is so much lower because of the water issue. So that's just one example. a couple of things with us. So like how we make sure that our clients don't close on something like this is, number one is we have a 200-point due diligence checklist that we go through during your due diligence period. I'm going to share that example here. So this is an example of our due diligence checklist, and it's 200 points. So there's basically areas where we talk to every single agency. So like this is ACHD, answer all the questions that would come up during their review. So even if we don't have time to get in front of that agency so like there's different, so without getting too far into the weeds, which we'll cover later on, but during review periods or review stages with the city and the agencies, they actually make comments. But typically, during due diligence, it takes a longer time to find that out uh, than what we can do in due diligence. So if we cover all this stuff on the front end in due diligence, we can find out all this information before we have to wait to get in front of those agencies, which sometimes can take 2 or 3 months. And so sometimes we can get the reviews, essentially the reviews that they would do for those meetings before that 2 or 3 month period. So we can cut our due diligence timeline down. But essentially, we go through and we talk to all the agencies, all the service providers, all the utilities. Like right here on the Veolia, for example, right in our due diligence checklist is confirming the fire flow information and if the water services uh, available for that project. So right off the bat, like literally within the first couple of days of talking to of doing due diligence on this previous project that we had under contract, we knew that there wasn't water pressure, but we didn't. So we knew that was a red flag. So then from there, the solution was to, okay, well, how do we work around the red flag? Because I should say it was a yellow flag, because a lot of times you can work around a yellow flag and come up with solutions that work. So like I mentioned before, the community well, we didn't know that that was not an option with the city of Boise. Now we do. And then there's still an alternative, so you can still get water. It's just too expensive for this property. Okay, so the next kind of I guess example of what can go wrong would be that you don't analyze a deal properly. And I think this is where a lot of investors get hung up, or they're worried about it, that because they just don't have all the information. And so a lot of times, ultimately as investors, you want to know what something looks like. And part of the issue with development is just that, you typically have to rely on multiple parties, and not all those parties know exactly what the deal looks like. So for example, if you go to an architect and say, well, can you design me this project? That architect's going to be able to design you a great looking project, but they're not looking at the end result. They're not looking at, okay, what's the profit look like? And then what does it cost to build? What does it cost to develop? How are we maximizing the highest and best use? How are we maximizing every square foot of this build? How are we limiting costs on areas where we don't need to spend money on? And so 99% of architects aren't going to do that, or plan designers. And so, a lot of times you're relying on, third parties that don't have that info or all the information. So the investors are relying on development deals, for, stuff that are kind of relative unknowns. And so one example I wanted to show you is actually on a deal that, was actually sent. Well, I saw it actually it's currently on the market, but then they're also trying to sell it off market. And so let me see if I can find this site plan quick. Yeah. So one of the things that I wanted to show was, okay, so this site plan, so this is on Adams Street and 43rd Street in Garden City. This is actually a pretty good location. It's getting better by the month. There's actually currently, I think this is either a vacant lot or just a single house, but then on this corner right here on 43rd Street, there's actually a current subdivision that was built, has cottages and townhomes, kind of similar to what this would be. It was built a few years ago, so that's good. And then directly across the street is also newer construction townhomes. So location wise is pretty good, and it's only like a block from the Greenbelt. I also have a couple of new builds that we built and sold, and a couple more lots we're going to build on just down 43rd Street. So this location I know really well. But when I look at this site, so they have it for 8 units. They have 2 cottages, and then they have 6 townhomes that are just set up as basically duplex style townhomes. So when I looked at this deal, I was like, okay, that's decent. So on paper, on the surface, um, I thought, okay, this might be a good deal. The good thing that this project has going for it is, number one, is it's fully entitled. So essentially, I don't know if they have the grading permits, but it's ready to get grading permits, and so the construction can start right away. On the surface, again, the density looks okay. It's a great location on Adams and 43rd Street there. And then the design looks pretty good. I'm not going to pull up the house designs, but they look pretty good. The floor plans looked pretty good. It was 2 bedroom, 2 bath each. But what kills this deal the way it is that the floor plans are too large for 2 bedroom units. So they basically designed 2 bedroom units at about 1,360 and 1,373 square feet. And so essentially that is a really large 2 bedroom unit. Let me pull up my analysis here really quick. Okay, it's this property right here. So they had so 2 bedroom, 2 bath. The cottages were 1,336 square feet with a 358 square foot single car garage, and then the townhomes were 1,375 square feet with 566 square foot garage. Now, both of these are actually almost the size of a 2 car garage, but they're just single car garages. So number one, that's a lot of square footage that you're increasing the build cost, and you're not actually increasing the sales cost along with it. So it's not an efficient use of space there and build costs. And then number two is these are just really large 2 bedroom homes. So basically you're increasing the build costs, where these 2 bedroom homes, you typically want those to be probably closer to 250 each in a build cost, and now they're over 300. And as a result, along with a few other things, but as a result, you're losing money on each cottage or on each development or each unit. So you're losing about 60,000. So even if your build costs were 250, which they could actually get a little bit lower too, but you're losing 60 grand on each unit. Now, there's a couple other reasons why this loss is here. Number one is because, ultimately it's an entitled project. So you're paying about 68,000 per entitled unit, which, for certain areas of Garden City, this isn't bad. The going rate right now is probably 60, 65,000. So we're not that far off here. The problem is you're also a bit high on this development costs per unit. It's really not horrible. But you could actually almost cut this in half. And the reason is because you can almost double this density. And on development parcels, so when you have, like, this is a 0.68 acre parcel, when you have to develop that for 8 units, it's essentially the same cost, whether it's 5, 8 units, 10 units, 16 units. So that's why maximizing the density will lower your cost per unit. Now there is, it's a little bit more, but ultimately you have a floor cost, and then there's a little bit additional cost per unit, but not much. And so ultimately we could get this build cost down to, probably 30 to 35,000 per unit if I look at some of these other developments, maybe even less than that, in that same area. And then all of a sudden, the other thing too is if you can make these the same square footage or even just a little bit larger, but make them 3 bedroom, now your resale prices get higher. And ultimately, this could be a profitable project if you doubled the density and made these 3 bedroom units, and made more efficient use of the space. But because it was designed poorly from the very beginning, in my opinion, this is, ultimately this doesn't make money. And even if I were to do this myself, which I wouldn't, obviously my build costs are, I have some profit built into this. So like theoretically I could go in and build this at my cost, but even at this project at my cost is likely a break-even project the way it's designed. And so it's really not a good deal for me or for an investor. But what I will say is this deal could still potentially work. Now, what that means is you'd have to essentially go back to the drawing board and redesign it. It wouldn't be a really tough redesign. Ultimately, you still keep all the infrastructure and most of the engineering. We would just essentially almost double the density. The units themselves are way wider than what they need to be. And I take that back before. I think the duplex units had 2-car garages. No, they didn't. They only had single car garages. Never mind. Because they're 2-story units. They had some living space on the first floor next to the single car garage. So what I would do is actually narrow them down and make them 3 stories, make the living space on the second and third floors, and then just the garages on the second floor or the first floor. And essentially you can almost probably pretty close to double the density on it. So then you cut your development costs in half, you cut your acquisition per unit in half. All that fun stuff. You add a little bit in cost on the redesign, but you can essentially probably make this work if you go back to the drawing board with it. So that might be something we look at further down the road. But ultimately, the reason why I wanted to bring this up is because a lot of people that don't have that either are relying on an architect to design the project, they're going to design something that looks great, sure, but they're not necessarily designing it from the very beginning with clear expectations or a clear exit in mind that's going to make money at every step of the way. So how we avoid situations like these with our clients and our deals is ultimately we're designing the project from the very beginning. We're still going to go and contract through professionals like design professionals, architects, engineers, all that stuff. But we're designing everything from the very beginning with the exit in mind, and we know the cost at every level. So because we're fully integrated, we control the costs on the entitlements, we control the cost on the development, and we control the cost on the vertical, and we know what all those costs are. So anything that comes up that we know is going to add costs, we can make sure that we design it properly, so that that cost is sufficiently accounted for and made up for on the resale side of things. Or if you're keeping it for rentals, obviously there's different ways we can design things too, based on what your goals are. So a lot of these we design for resale, but we do have clients that say, okay, we want to keep these as rentals. And so we design those differently than we would as a for sale product. And then same thing, on the rental side, if your long-term strategy is to hold it as a long-term rental, we're going to design that differently than we would if you're going to hold it as a short-term rental. So we actually have 2 projects right now for clients that one's going to be built as a short-term rental unit. The other ones are going to be built as long-term rentals, and we're designing those projects completely differently. Not completely differently, but differently, mainly on the build side, because we design it differently to maximize the use and profitability for each of those. Okay, so another risk that would come up is that the project doesn't get approved. And so this was actually kind of interesting. I had another developer or agent message me yesterday, kind of interested, but he or saying he had a client interested. But one of the things that he mentioned when he was asking about rezoning, and most of the deals that we have, we don't have to rezone. There are a couple, in fact, there's a couple currently that we have that would require rezone in order to execute the way we want to execute. And so, he was like really hesitant on that, which is fine. I am too. But one of the things he mentioned was like, that they lost $450,000 on a deal because the subdivision didn't get approved. And so obviously that's a legitimate risk. And what I told him is, ultimately with our process, we don't have that risk. We're not buying and that, ultimately I didn't ask him the details specifically, but that was probably like a 40-acre deal out, either past city limits or with the wrong zoning. And, ultimately there's certain things that you really have to pay attention to on things like whenever you're doing something that's outside of the box that is normally allowed. One of those is a rezone. So, you know, a rezone, there's obviously additional risk there. And so one of the things that, you know, that we do on our deals, that if they require a rezone or something that doesn't fit inside the box, is that we, number one is we, you know, uncover a lot of that during due diligence and make sure that the feasibility, or the probability of getting it approved is high. So if the deal is like, so let's say if we can get through due diligence and say, okay, this is 90% likely to get approved, after we complete the due diligence risk, you're obviously reducing your risk quite a bit. Now, most of the time, I would recommend that we don't close on it, you know, even with 90% certainty. So most of the time, in almost every scenario, particularly in my system with clients like this, is that we would put the closing as contingent on annexation or rezone, and project approval from the city. So most of the deals that we do, we close sooner than we have project approval. But something like something that's more complicated, like a rezone or annexation, um, you know, we're going to put that in the sale contingency, that we're not closing until we have that approval. And then during that due diligence period, we're going to get to that 90% likely. And then, you know, maybe you release some earnest money to the seller in order so that you can, you know, do that extended close with them. But at that point, you know, your risk is fairly minimal for the potential reward that you have with it. So, you know, most of the time that's a, you know, risk reward scenario. But it's better than closing on it and then finding out afterwards that you don't get the project approved, and now all of a sudden you have a project that's not worth as much. The other thing I'll say about that too is you should never be, from the very beginning, you shouldn't be paying more money than a project is worth based on new zoning. So for example, if you have a property, so this is actually a great example. 11913 West Victory Road is a deal that we had. It's currently a deal that's active, and it's still a possibility. So this is one of our active deals. Let me find this. Okay, so this one right here, where you have basically about a $450,000 potential profit on this one, for minimal, so fairly minimal investment. But this profit is relying on being able to annex it and rezone it. And so I guess what I was getting at is that, I forget what I was mentioned previously, but ultimately this property has that's what I was talking about. So this has a house on it, the way it is. So the way it is right now, it's zoned RSW in the county. And so RSW essentially is a placeholder in the county, saying that ultimately it's going to get rezoned at some point. It's going to be annexed into the city. It's just a placeholder. So it's essentially, it'll get rezoned at some point. But it's not zoned for what we're trying to do with it. So why would you pay, let's say if this was zoned properly and it was already approved for, you know, a 12 unit development or whatever, which is, you could do a 12 unit development on this, maybe it's worth a little bit more. But since it's not zoned that way, why would you pay that money if you have to do all the work and put the time into rezoning it? You're not going to pay extra for this. And that's where your biggest risk comes in, is if you're looking at a development deal and you're saying, okay, I'm going to pay extra because because I can add to the density and rezone it. You're not doing that. You're actually adding value when you rezone it, but not before that. And so ultimately this house, the way it sits, is actually worth 550, we feel, or very close to it. And so you're essentially, on this deal, you're getting the land for almost free. And that's ultimately why this is such a profitable deal, compared to how much money you have to put in, is because you have a lot of value, or you're creating a lot of value. Not that you have value going into it, you're creating a lot of value by rezoning it and getting it approved. So ultimately we would rezone this to R1C. So this is an example though of one that we would have, that we would say, okay, it actually makes sense to annex this and rezone it. And the reason why is, when we looked into this, like it's literally right next door and right across the street from the city, like it's borders the city property, or the city limits right to the north and right directly to the east. And so it's already right next to city limits, and it's already right next to the zoning that we want. And the future land use is also the proper zoning. So basically like those three big check marks are green flags for most likely being able to rezone this. Now there's still a risk there. So that's why we would say going into this, we're not closing on it until we have those approvals with the city, that it's going to be annexed and rezoned. And then the approval process for this development is actually less time than it takes to annex and rezone. So as long as you have that annex and rezone, and that project approval can actually be done concurrently. So we'd have yeses on all that stuff before you ever actually close. And then you de-risk the deal now completely, because you still have a house also that's worth the same amount, whether it's, developed or not. Okay. So a few other risks here. So what are some of the other risks that so investors would worry about on deals? So number one is, what if you run out of money? So, um, there's a couple of solutions to this. So number one, I think the most important part is that ideally you aren't investing 100% of your liquidity and net worth into a deal. So, even if you're investing a huge chunk of your liquidity into a deal, if not all of your liquidity, ideally you're not, emptying out all of your investment and all of your potential liquidity down the road into doing a deal. So, ultimately we don't think that's a great idea. Obviously you're free to do what you want, but ideally, even if you're, using most of your liquidity to invest in a deal, because they do have like most of these deals have better payoffs than most other investments that you're going to see. Ideally you have backup plans for worst case scenario situations, where you can tap into other net worth or other resources. And then there's also, if you have friends or family members that want to invest in deals, maybe you use that money on the front end and keep your liquidity as a rainy day. What I will say too is, when we analyze these deals, we analyze them, number one, conservatively. So ideally, they take less capital, or they take less, or they're ultimately they cost less than what we're analyzing these at. And so ultimately our goal is to under promise and over deliver on everything, but there's no such thing as a perfect deal either. And so the other thing too is, the other point I wanted to make about development is that there's multiple exit points along the way. So most projects that we do, that we encourage our clients to do, that they're going to be profitable at every step. So typically you get more and more profitable as you go along, but there's 3 or 4 distinct exit points on every development project if you're buying it from an unentitled project. The first exit point is just on a concept. So essentially, if you're buying, let's say you get a piece of land under contract and it's just raw land and nobody's put together any kind of concept plan for it. So this is the cheapest way to do, like, we actually do concepts like on our high level underwriting all the time, where we just put together a deal, you underwrite it, and then you can theoretically, without ever even closing on it, you just remarket that as a concept. Now, in order to do that, you'd have to have it off market, because you can't necessarily remarket it online if it's an online deal or MLS deal. But that's the first exit point, is just doing a concept. A lot of times you can improve the value just with a concept. That's less and less the case, recently. But there's still some deals that works. The first exit point is that entitlement. So once you have it fully approved through, the various agencies, so basically like the city, once the city approves it, once you have the civil engineering plans approved, you can exit at that point. There's actually 2 different entitlements. Number one is you have a project approval, and then number 2 is when you have the civil plans approved. So you could exit at either point. If you have the civils approved and you have a shovel-ready project, it's going to be worth more. And you'll be able to sell it more likely, or more quickly, because you are cutting off additional timeline for that developer or builder that's going to buy it. And so our first exit point there, for most of our clients, we want to make sure that it's profitable at that point. And most of the time you're not adding enough value there that it is profitable. There's certain cases where it's not. And most of our investors are going through all the way to the end. So there's certain circumstances, even if it's not profitable there, as long as there's not a huge risk to loss, maybe it's just break even, or maybe you're just going to make a little bit of money, or maybe there's risk for a small loss because of sale costs, whatever. That might still be worth it as long as the reward on the other phases is big enough. So then the next phase is at the end of the development. So the development is where you put in all the infrastructure, you get the plat sign, and now you have individual lots that you can sell. And so you can either package those together to a builder and sell them at, a little bit lower rate. And that's usually how we price our deals, is that if you were to package the lots together and sell them to a builder, or you could sell the lots off individually. That's going to take longer time. You have to wait around for the right buyer that's going to essentially pay a little bit more for it, and they're individual buyers. But those are two exits at that point. And then the third exit is on the final build. And then that final build, you either exit with a sale, or maybe you're keeping it as rentals. Then the exit is just to refinance into long-term debt. And then the other risk, there's there's timeline risks. So like I mentioned previously, no deal ever goes 100% to the plan. So we try to be conservative on our timelines and bake in additional time and costs to cover these any unforeseen delays. So I always tell people, if a deal goes perfectly, you could theoretically be out in less than 2.5 years on a traditional subdivision, but almost all the time the deal doesn't go perfectly. So we factor in it's going to take 3 years. Sometimes we even underwrite longer than that if we feel like might take a little bit longer potentially on a more complicated deal, or depending on the approval agency. And then there's the construction risk. So what if the construction costs go up? Um, so again, we typically bake in reasonable inflation cost or analysis from the very beginning. So that's included in our numbers when we run these things. What we don't factor in is, like in 2021, when we had 30% inflation in a year on construction materials. We had projects under construction at that time that went from, they were going to cost us 170,000 to we were lucky to be finished at 220,000 per home. And that's just my cost. That's not what I would charge somebody else. So that we had, $50,000 increase in construction costs per house. Now, the benefit to that is we actually had, our home sale costs went up by 250 grand in that same period, or from the period when we got under contract to by the time we sold them, we sold the houses basically between 250 and 350,000 higher than what we originally analyzed the deal at. So we had the benefit of timeline there, as far as holding on to it. So that worked out in our favor. But if it was a shorter deal or the market was different, that's definitely probably one of the biggest risks. Is not the biggest risk, but one of the biggest risks is just the construction costs. And so how we kind of combat that and give people kind of um, some ease is that we have our profit guarantee. And so that's basically designed to mitigate risk for the investor from the beginning. And I would say, most of the time, like if you look over the course of the last 50 years, 2021 was it was a crazy time, obviously, for construction. I think that's been the worst case of inflation, well, aside from maybe the 80s, but even in the 80s, I don't think it was such quick inflation that we saw over the course of a year. So anyway, so we do our profit guarantee, and so that's designed to mitigate risk, and then ultimately give you a little bit of reassurance that you have a relative floor. Now, obviously, there's not completely risk-free deal, but we do that to essentially have our skin in the game as well. And then utility risks. So what if utilities aren't available? Again, this kind of comes back to making sure that the due diligence is done thoroughly enough. So like when I looked at that Hill Road deal that was previously approved for 12 lots, I actually knew. So I looked up all the paperwork that was previously approved, because I was like, how did they approve that if the water line is an issue? And so I was curious if they actually solved the water issue, or if it wasn't a deal on that lot. And at no point in those approvals did it actually cover the water issue. So the plan designer mentioned that they were going to upgrade facilities but he didn't say anything about costs or more specifics on it. And then one of the conditions of approval is that the water service would be brought into the subdivision, but they didn't necessarily cover how that was going to be done. And so that's ultimately why I think nobody ever developed it, is because that once they went down that path and found that, they realized that the cost was too high to actually develop it. So again, having proper due diligence and thorough due diligence, we uncover this issue. So that's really not a non-issue for our clients. Then financing risk. So this is one of the biggest, issues that we had in the background, or that we've been working on in the background for the past several months. So going into this setup, we knew that the financing was always going to be a little bit of not a problem or an issue, well, a little bit of a problem, because ultimately most construction lenders want to lend to me as the builder when I own the project. Since I don't own these projects under this system, it creates a little bit of an issue with the lenders, because 95% of construction lenders out there want to lend to me and not the investor themselves that don't have experience in developing. So we've actually been working really hard behind the scenes. We already knew we had a couple of lenders that would do it. So we already, we got a couple projects that we're currently going through entitlements and everything, that we knew that we could get financed. But those lenders don't always have available funds. We knew that we're going to have to find additional sources. And so really over the last couple of months, we've been working hard on this behind the scenes, and establishing new relationships with lenders that will lend to individual investors. So you still, individual investors still have to qualify under them, but typically, if you have the liquidity and net worth that is going to take to do these types of deals, they're typically going to lend on it. And then they use my experience. So we actually have like 4 really solid lenders now that'll, and ultimately 2 of those lenders have essentially unlimited funds. So this is mostly solved. Obviously, it's still got to go, we got to do this during due diligence to make sure that it works for a lender, and that investor that's buying it, it's going to work for. And then I would say the biggest risk is just the market risk. So, what if the market changes over the course of entitlements and developments? Obviously, that's, outside of the control of anybody. And so this is ultimately the biggest risk that you have to kind of deal with. These deals do take a little bit of time. So the shortest deals are like a year, longest deals are 3, 4, 5 years or more if they're multi-phase developments. Now, typically time works on your side just because inflation. Inflation works on the resale side too, and it usually works out because you have a larger spread, and that spread is getting larger every time. But you have, issues where, something can happen in the economy and you have a shorter term, market fluctuation in the negative at the exact time that you want to sell a property. And so there are situations like that. Most of the time there's enough margin to, keep you from losing money. But the other thing we do too is, again, that profit guarantee is designed to at least have a little bit of extra buffer there before you have a significant risk. And then, ultimately we're also really conservative on these. So typically these deals are going to work out better than what we're underwriting them as. But in the case of, large market fluctuation at the wrong time, there's no such thing as a risk-free investment. But we do a lot of, work on the front end to make sure that we're analyzing them properly and conservatively. And then we also, again, have that profit guarantee to make sure that you're not losing money when we're making money, that kind of thing. Okay, so a few things that, what what makes a good deal a great deal, or a deal a great deal? So the few things that we look at is number one is it's on a large enough lot. So we do anything from single lot splits all the way up to mid-sized developments. So you just want to make sure it's on a large enough lot, depending on what that strategy is. Has the proper zoning, existing utilities on the site or close enough to the site, that it's a flat property. Now, if it's hillside, that's not a deal breaker, but there's additional due diligence to do on that. Good neighborhood, multiple exit strategies, conservative margins, little competition. The one thing I want to mention about that is infill development. There's only like a dozen people in Boise, that maybe a little bit more, but let's say a dozen guys are doing anything at any kind of scale, more than like 1 or 2 units a year. And so there's very little competition anyway, versus like flippers. You probably have 50 flippers out there, that are competing for every deal, or a lot of deals. So there's very little competition. So that protects your margins. And the reason why that ultimately is because there's a higher bar to do development, for a lot of the reasons we've already mentioned. And then you want to buy it at or below market price. So, you never want to buy a development deal for over market value, because of what you can do with it. You want to look at it at, what's the market value as is. I will say an exception to that, because ultimately there are development deals that are, you're looking at, okay, this is what I can do with it with the zoning. And it's, if it's a single family house that sits on 5 lots, but you have to tear down the house, you're going to look at that at, okay, the market value of the house is this, but then the land value is this. Sometimes, the land value is more, sometimes it's not, but you do want to look at it from an angle of like, okay, what can I do with it? And that's what the value is worth. But you don't want to pay more for it. Like if you have to rezone it, you don't want to pay for the future zoning and not the current zoning. Okay, so some of the instant red flags. So having only one exit strategy, I think that's where some beginner developers kind of go wrong, is that they only have one exit strategy. And so they'll look at it from, okay, we're just going to entitle it and sell it entitled. Well, they don't have an exit plan. Well, I guess what I'll say there is not that they don't have a good exit plan, but there's a lot of times, especially in Boise, there's not a lot of deals that go on the market that are entitled. And so comps are hard. And so, some of these guys that buy them to entitle them and then put them on the market, they don't know the cost to develop and build. And so they're kind of guessing at those things, and they're not working backwards from that. And they're just guessing at what it's worth entitled, and when they don't have really solid comparables. And so I think that's the biggest mistake, especially land flippers are making sometimes, is that they're saying, okay, we're going to put 100,000 into getting it entitled, and we're going to sell it for a $500,000 profit. Well, most deals that doesn't work, especially on infill. Maybe on a 40-acre, parcel where you can develop 2,000 houses. That's too many for 40 acres probably. But anyway, on a large deal that might work, but on a small infill deal, like if you think you're going to, make that kind of money on an entitlement, that's typically not the case. You have to understand the different exits and how much each exit costs. And then just having tight margins or difficult utilities. So the one thing I'll say is, if you're looking at annexation and rezone, you need to make sure the utilities are nearby. The deal last week, actually, I didn't realize this until late. We actually dug into it a little bit deeper. Is the deal I had last week, the deal of the week, there's actually no water main line in the street out front. And so automatically, when we start digging a little bit deeper, we're like, oh, that's kind of a yellow flag, not a red flag, but a yellow flag. We did find out it was 600 feet down the road, so it actually still works. And I knew there was some infrastructure I had to go in, so I actually had pretty healthy margin, or pretty healthy infrastructure budget. So I think it still works. But we have to do, we have to do further research on that stuff when the utilities are not perfect. And then expensive site work is another thing. So, hillside is where that mostly where you get into that. Or if you, like in Garden City, you have the floodplain. If you have to bring the whole site, if you have to increase the elevation of it by a couple feet, that could get expensive. So you just need to make sure that you're looking at all those risks and costs and mitigating those appropriately. And then The other thing is entitlement risk, and along with that is significant neighborhood opposition. Now, what I will say with Boise is Boise on a lot of these developments now, with the exception of subdivisions. So subdivisions, you still have to go through city council and planning and zoning. But a lot of these, well, so on cottages, you don't have to go through that. On subdivisions, you do. What I was trying to get at is, even if you have neighborhood opposition to a subdivision, if you're fitting inside the box that the planning and zoning gives you, there's really nothing that the neighborhood can say that will deny that project. So if you're fitting inside, so there's a box of like fitting inside of all the rules and regulations to get something zoned or get something approved. And so that's the reason why we have a planning and zoning code. So if you check all these boxes in and you keep it inside the box, there's really no way that that project can get denied. Where that project can get denied is if you're trying to do stuff outside the box. So one of those is a rezone. Um, one of those is an annexation. One of those is asking for a variance. If you're relying on your project to make money in order to fit outside that box, and you have significant neighborhood opposition, you have to really analyze that further. And ultimately, maybe you don't do the deal, or ultimately, maybe you try to get those approvals before you close on it. Okay, so getting back to, why isn't everyone doing these deals? So basically, most investors just don't know anything about development. There's not a lot of information out there, and there's a ton of nuance. Every city and town has a different zoning code. So once you get to know how zoning works, you can go from one town to the next, and there's a lot of similarities, but the structure is always a little bit different. And so there's a lot of nuance to it. And so most investors don't want to invest in something that they don't understand. And that nuance is hard to understand from town to town. And so ultimately, you kind of, as an investor that is not a developer, you kind of have to rely on the experts. And it kind of goes back to that whole thing, like, well, you can hire a plan designer, but then they're not going to, necessarily design it for the best outcome on the tail end. So you kind of have to understand those things as an investor, or rely on people like our team that has the experience, and we've set up this system to be able to kind of address those things. And then just, not knowing costs at every phase. So you have phases: entitlements, development, building. It's hard to understand those costs. You can say, okay, we think it's going to cost $200 a square foot to build. But most people don't know it costs more per square foot to build a smaller unit. It costs less per square foot to build a bigger unit. And so there's a little bit of nuance even to that with costs. So you have to apply that based on the property and what it can fit and what's ideal for that neighborhood. So that comes to highest and best use, is like understanding what highest and best use is. It's not just about getting the most units on there. It's what's going to sell for the most amount per square foot, and ultimately what's the best product for the neighborhood. Is that luxury detached single family? Is it luxury townhomes? Is it entry level single family? Is it cottages? You really have to understand, or look at what the best product is for that market as well. Then another thing too is, nothing against realtors, but 90% of realtors are really just representing buyers and sellers of traditional properties and don't understand real estate investing, much less development. So, um, you know, uh, most realtors aren't talking to investors or aren't presenting these deals to investors because they just don't understand real estate investing. Um, and then ultimately too, like a lot of these deals, some of them are off market. Like we have this one off market deal right now. We have a couple off market deals that we're actually going through entitlements for clients. But ultimately, there's deals sitting under everybody's nose just because they don't understand how to analyze them, and they don't understand where the opportunity is. And where we see a huge opportunity right now that's kind of a win for all the parties is with these cottage developments. They're relatively new. It's a new zoning code. There's a couple of them currently in development. So we're going to see them more and more. We have, we keep pushing them. We have one that we're currently getting entitled, and we'll start construction actually probably in January or so. So that'll be a big step, I think, in the right direction for us to be able to show what we're doing. But most investors don't understand these. They don't understand the zoning for it. And there's still, just because it's kind of a new thing, people don't understand it and don't really get it. But we do. And so a lot of that is just trusting us to kind of go through that. Okay. So basically, just wanted to cover really quick the process of an infill deal. So number one is when you're interested in a deal. So the number one is kind of that initial high level underwriting. And then once that looks good, you get it under contract, make sure the due diligence period is long enough. We talked more about that. But basically going through that due diligence period, then going through city meetings is part of that due diligence. And then once you've gone through that due diligence and you feel good about it, you move on to entitlements. So that due diligence process typically on most deals is around 30 days. It could be shorter or longer depending on the deal. Then we move to entitlements. And usually you'll either have already closed on the deal, or in some cases you're doing an extended close. Entitlements for most projects is usually around a year. And essentially that's a couple different phases in itself. Number one, you have to have planning and zoning approval. Then you have to go to city council, typically on a subdivision. There are some new processes now where you get to avoid those steps. And they're just approvals through staff at planning and zoning. So that cuts off some timelines. Then once you have the project approved, then you have to get the plans approved. So then you have to get the civil plans approved, and that takes a few months. So overall, it usually takes about a year. These cottage developments, typically right now we're looking at, like, they're probably gonna be taking about 9 months to get entitled, possibly a little bit less. But usually you can cut off a few months because it's a staff level review. And then you go through the site development. And then part of that too is like, getting financing in place and all that fun stuff. That's just part of entitlements and due diligence. Then we have the site development, that's putting in all the infrastructure. So for a typical subdivision, that's also a year. It doesn't take a year of construction. That's usually 3 to 6 months, but then you have to get the plat signed, and that takes 3 to 6 months. So typically, that's usually we factor in about a year to get it developed and then be ready to go vertical. On these cottage developments, you actually can go straight from horizontal to vertical, or do it at the same time because it's not a subdivision. And so you don't have a new plat to get signed. So essentially you eliminate 3 to 6 months in the middle there, and even potentially some build time, because theoretically you can do it at the same time. Logistically, that's another question, but at the very least you can go straight from horizontal to vertical. Then you have the construction side. So that's the vertical where you're actually building the homes. Construction typically takes 5 to 7 months. I'd say 6 to 7 months on most projects. And then you have the exit of that. So that's another, few months. So we typically factor in a year for each phase: entitlements, development, and vertical. That's for a traditional subdivision. Then again, if it's a multi-phase, it could be longer because each phase is typically going to be a year or two, depending on how you structure it. And then cottage developments, typically you can cut off a year of development time, because you're not, number one, you're saving time on the approvals, and you're also saving time on that plat signing. Okay, so hopefully that was a little helpful. Brian, do you have any questions with any of that? We're actually,
Not really. I was just kind of just looking over all the deals that you brought up. Say something was entitled, and we had to go back and like replot it. Is that like an accelerated timeline, or is that just start from scratch?
yeah, it would be, because essentially, so like that project in Garden City where essentially more than likely the roads would all stay the same. Same thing with like all the utilities. That engineering has already been done and approved. It would have to go through another review, but it wouldn't be have all the back and forth. So you'd have to get it again approved through design review, planning and zoning and city council. So that's going to take 3 to 4 months because it's basically a month for each. And then you have to get the civil plans approved again. But ultimately, if the civil plans are staying mostly the same, it's more than likely just one single review, maybe two. And so instead of it taking 12 to 18 months to get reviewed, then it's like probably 6 months total to get it approved instead of that 12 to 18. The other thing too is I think the sellers of that property, for specifically that property, they it sounds like they own it outright, so they might be motivated and willing to do some kind of creative deal, like where maybe they carry some or all of it, or do an extended close, something like that.
Okay. Yeah, I don't have any other questions. I was just kind of like, sometimes they put up a red flag, but maybe sometimes later down the road, there's a way around it and getting the price down and
Yeah.
resubmittals and stuff like that. So,
Yeah, exactly. So like that one was a good example. There's another I have another deal a week from a few weeks ago that was a cottage development that it's actually approved for a subdivision of like I think 7 homes, but the price they're asking doesn't work because the all the infrastructure that has to go in for 7 homes, it just even if you got it for significantly less, it still doesn't work. And so I reanalyzed it as rezoning it and entitling it for cottages, and it works out great. And the sellers, I think, are in such a, again, it's like one of those situations where I think they're in a little bit of a bind. But I think it's the lender themselves. So I don't think there's actually like a loan on it or anything. I think it's actually the lender that's selling it. And so I think there's probably some room to negotiate in order to be able to do an extended close where, okay, in order for this to pencil, if you guys want to get the money you want for it, you're gonna have to let us get through this and rezone process. So um, but yeah, those are, good examples of like they may not work the way they're shown. Um, both of those deals, I would have designed them differently from the very beginning, and that's just, again, that's just kind of I think not everybody knows exactly what they're doing when they're doing these deals, but um, ultimately they could be potentially profitable just with a redesign, and it's just a matter of like how we go about that. All right, I was expecting a few more people live today, but they're probably watching on YouTube later. I know I'm going to have people watching on YouTube later. So I wanted to kind of shout out to the people that are watching this on YouTube. If you do want access to our deal list full time, where basically you get access to every deal we underwrite, just send me a message directly and I'll go through the steps on how to get there. And then also, you can sign up, I think on the link to in our YouTube, also, you can sign up for our weekly calls. So we review deals live every single week. We do our deal of the week and then also usually a couple other deals. And then we also cover a little bit of education, and then it's also a great opportunity to ask questions and everything as well. So if you're watching on YouTube, um, click on my link tree in the bio there, and then you can kind of reach out to me in a few different ways there. Appreciate you listening, and we will see you next week.